So as we go through what we think the Fed is going to do, which for those that have been following us, we think we do get a 1/4 point raise in June, and then we'll stay at about that 5 1/4 for about 12 months is kind of how we're looking at this over the next, not only just through 2023, but also heading into 2024. Now, one of the things that we've wanted to look at, just because this is a key piece, leading economic index from the Conference Board fell by negative 0.6% in April, taking year-on-year trend further into negative territory. 8% decline consistent with prior recessions going back to the 1960s. So that just means that we have never gone this low and this continuously low without having a recession. So that just means what everyone thinks it means. Again, there's no confusion in terms of what this looks like. The leading indicators continue to show softness. We're going to talk about Philly and Empire today just because those have come out. And as we had discussed, we thought the Empire numbers were a bit skewed to the upside, which is why we look at so many different data sets. And that has now continued to move down. So here, when you look at commercial real estate, it's not surprising. Commercial real estate, the most likely source of the credit event. U.S., EU commercial real estate, as you can see, the fear continues to rise. U.S. shadow banking continues to be a concern. And then when you look at U.S. Treasury being downgraded, that continues to move up in the realm of possibilities. I don't think that's surprising to anyone who's been paying attention. The commercial real estate side is clearly a concerning piece. Now, when we look at target rate probabilities for the June 14th meeting, if you remember the first time we showed it, there was a 98% view. There was a view, based on kind of the betting and probabilities, there was a 98% chance of no rate hike and a 2% chance of a cut. Which we thought was absurd, but here is the update. So now there's a 32% chance of a rate hike and a 68% chance of a no hike. But again, I think this is kind of the right, and to be honest with you, as the data continues to come out, we just think that it's going to skew further towards an additional rate hike, which just based on some of the data we're going to show you, everyone sees it, the Fed sees it. The retail sales, which we'll talk about, were concerning from a real perspective. But again, nothing that points to we need to cut, we need to get aggressive. If anything, it keeps, I think that quarter rate point very much in play. But we'll talk more about that in the next segment. So when you look at global commodities, global manufacturing PMI to new orders, you're seeing these pressure points. You're seeing global manufacturing PMI and the new order side is pushing down. Again, there's more and more pressure points that we continue to see. It's not just in the U.S., it's on a global level. In the U.S. being the largest buyer, you're seeing these broad reductions, these broad pressure points, which again is showing in a lot of these commodity currencies. And then when you look at the nominal trade weighted USD, you continue to see some of these different shifts. We don't think it falls. We think, again, it goes sideways at this point. The bigger issue is going to be new orders and that global manufacturing. So then when you look at, taking the global pressure side, because the U.S. is such a big piece of that, and then you start looking at some of the diffusions of, okay, well, where is CPI components the biggest concern? And when you look at it, when you look at the over 4%, there is still over almost about 75% of stuff that we buy and the components we buy are still over 4%. That is a big issue when you look at some of these underlying problems and these fear points. Between 2 and 4% is fairly low because most of this is over 4%. You're seeing a huge component that continues to be, and why we think that this is not, again, we've been saying forever, it's not transitory, and here's just more of that support. And then following on that support is when you look at some of these key pieces. So even with the refinement for the PCE sticky group is still more comprehensive than CPI Supercore. And this is where we love what Powell likes to talk about because at least the PCE sticky group accounts for 41% of the consumer basket in comparison to Supercore CPI, which whatever that is only 24%. So you're going to tell me only 24% of what the consumer buys is a good indicator of consumption. Like, at least use the other one. So the exercise reveals that there has been barely any disinflation progress in recent months. In fact, the sticky group, which is the PCE sticky group, or I call it the core of the super core, actually accelerated in April. And again, when you look at PCE versions, which is going to come out May 26th, a week before the next FOMC meeting, there's more and more pressure that we're going to see with this going higher. Now, there are two problems with the interpretation of what is happened so far in inflation. The CPI super core measure is a poor proxy of the one Fed Chair Jay Powell watches PCE core services, excluding housing rents. There's, when you look at some of this, the CPI version accounts for only 24%, while the PCE analogy accounts for, now, again, there's the sticky, and then there's the broader one, accounts for about 50%. The PCE index is, more comprehensive measure of prices in the economy, taking into account healthcare costs that employers have to pay on behalf of workers, airfare and hospital and physician costs. And these are categories that are very key. And that's why when you look at the stable inflation, when you look at that core of super core, so we're talking about the one on the right now, you look at that, there's a lot of stability. And what we've been talking about is sticky is not going away. You're going to see this pressure point that's going to stay there, which is why we think the Fed is going to have to continue to get more aggressive. Most think the Fed cuts rates in the first half of 24. A third say the Fed cuts rates in the second half of 23. But when you look at that kind of pivot, as we've gone from April into May, there's more and more people that think that this is going to bleed into 2024. So for those that have been following us, we've said that they're going to keep this here for at least 12 months. With the likely piece, which then means that puts us into Q2. So we would fall, if the B of A were to call me, I would say Q2 of 24 is when I think there's a cut, and you can see that more people are starting to think like I am, and that's something that was, but to be clear, when we started saying it, nobody believed us. So we're not jumping on any bandwagon. This is something that we've been very consistent with. So market pricing for the Fed fund rates, as you can see, is continuing to move up. But as that happens, the credit standard at 2020 levels and deterioration continues when you look at the credit standards that are out there, which just means that credit is harder and harder to get. And that is not something that we see changing. When you look at the rapid expansion of money market funds, it's facilitated, again, that massive global debt accumulation in recent years, and that's a problem. When you look at U.S. money market funds, the accumulation there, that becomes a bigger issue in terms of what the banks have available, how things are shifting, and why you're seeing that pivot between deposits and other, because the banks don't have access to this kind of capital. When you look at flexible sticky, looking at the rolling over a bit, sticky rolled over a touch. But again, if you look at the expectations from 2020 till now, there was always this expectation of this, big up, down, and it kept getting moved over. But what we've been saying is that you're going to get that kind of V-shaped, that upside down V-shape, inflexible. That was going to happen. That was what we've been saying. What we've been talking about is sticky was not going to do that. You were going to see some of this, again, just kind of pegged to the upside. And here you're starting to see sticky roll over a little bit, but you're actually starting to see flexible bounce. So again, you're going to kind of meet in the middle at this point, where sticky will continue to roll over at a slow pace, but some of that flexible is starting to come back up and creep higher. This is all happening as the Fed wage tracker continues to roll over a touch, but roll over is relatively speaking, because when you look at it, you can see that we're still very high, and the pressure remains real, and that's not something that's going away, especially when you look at the Zillow observed rent index versus CPI. So you've actually had some of that, the rent index bounce up a bit. There's still downside, obviously. There's still going to be, you're still going to see some of this normalize, but it's still positive. And that's why we see, again, that stickiness still remaining. When you look at deposits at large and small banks, you can see that there's been a small increase. But as we've been saying, nothing dies in a straight line. There was an overreaction to the downside, and now you're going to start seeing people, reaccumulate some of these deposits in both banks, both large and small banks. But again, we're not going back to where we were. There's still some of that concern out there. People are still looking for interest rates. As savings accounts start to pay more, people say, okay, well, does it make sense to keep it in money markets or to put it back into savings? But to do that, it's going to cost the bank money, and that's something that we're going to have to watch. But as that happens, the Bank Term Funding Program balance still remains elevated. Remember, this is emergency funding, which is showing that there is still fear out there. When you look at commercial and industrial loans, it continues to kind of roll over, and that's something that we think is going to continue, especially as the money market fund assets, as you can see, continue to grind up, because banks need deposits to then go out and make loans. But as their bad debt expense goes up, there's less money to make loans. And as people take their deposits out as savings and plug them into other programs, you're going to lose the ability to do that. And again, that's where you see the stress continuing to rise. Cumulative capital flows. So what is the money doing? So here you can see institutions have been pulling money out of equities. There's a view that this is something that means that people are going to be buyers, that you're going to have support in the market. But again, you're seeing more people go into ETFs. You still have individuals that are selling, but again, they're actually starting to come back up. The TD Ameritrade investor movement, you're seeing some additional buyers of equities. And the problem for us is we see that people are kind of getting sucked back in, and when it should break out, we do see that additional downside move. So it's going to be important to watch to see how these triggers continue. U.S. import prices have started to roll, which is a good thing because, again, that's a little of that leading indicator for the different CPI side and the different pressure points. But we just wanted to reiterate the credit standard side, because even as the way that you're going to get inflation coming down is by slowing the velocity of money, which is coming from the credit standard side. So again, banks in second largest state economy are at 2020 levels and expected to keep dropping. And again, bankers are just saying that, look, they're not lending. Unless there's some government backstop, subsidy, the exception, they're frozen. They're essentially saying, look, we're not lending, tightening up, which is going to slow the economy further, and again, put pressure on where that momentum is, especially on the economic front, which we don't see changing. So that's what we have for you here. But even as that happens, again, there's still more to come. There's still more pressure, and that's why we do think that there will be one more quarter point, and then that's where we're going to sit for an acceptance for really at least a year or at least a 12-month period. So now we're going to go towards the consumer and what's happening on the consumption front.